Hello and welcome back to Southbank Live. Here we are with episode 28, and in this episode we have a very special guest. This is Akhil Patel joining us today this evening. Akhil, welcome to the show. We have plenty to discuss. I thought maybe just to begin with, you could give us a little introduction with what it is that you do, your proficiencies in economics, and then we can go into some of the very interesting stuff regarding your grand cycle theory.
Well, thank you very much, Boaz, for having me on the show. And it's really good to reconnect after what has been quite an interesting couple of years. Just a bit about me in terms of what I do. I am the director and co-founder of a consultancy stroke subscription service called Property Share Markets Economics, where we produce commentary on the economic cycle, the stock market, commodities, and so on. I also work part-time for an international development bank headquartered in London. And the third arrow in my quiver, shall we say, is I'm currently writing a book where I'm setting out, in detail how the cycle works and most importantly, what investors can do about it. So that's me. Now, I specialize in talking about the 18-year economic cycle. You call it the grand cycle. I think that's a very apt description. And it's essentially a cycle that takes economies through periods of boom and bust. Typically, it's 14 years of an expansion interrupted by a mid-cycle slowdown and 4 years of pretty significant crisis, an economic depression, banking bailouts, a lot of economic and political turbulence. And that typically takes 4 years to complete, and then the cycle is reset and it starts again. And the cycle in the US and the UK has been going on for about 200 or 250 years. So it has a very long historical significance. And if you read history through this lens, you can trace the cycle quite clearly.
Indeed. Now we will dive a little bit further into sort of the history of the cycle, and I'd like to explore actually a bit how it's been suppressed throughout history, because it's somewhat dangerous information considering what its consequences are, and what it means. But just to wind back a little bit, this is our 28th episode. If you have been enjoying these shows, do give us a like and subscribe, please. Or if you are, and indeed if you are watching the show, great and hearty welcome to you for joining us, because it is very good to have a live conversation with our viewers. We do have a few folks in the chat. Good evening to you all. And indeed, we have some questions from the chat as well, which we shall be getting onto later on this evening. But Akhil, originally when we first got to know each other, I was quite skeptical of some of the radical ideas that you proposed. Though over the time that we've known each other, I've been thoroughly turned around to your way of thinking on several things. I thought we could start just a little bit with the 18-year cycle. It all comes down to land. Is that correct? That's where things really begin, and how land prices ultimately affect so many other different prices in the economy, and also in a way create the boom bust cycle that we have. So I thought we could just start there a little bit, and then we can delve deeper into some of the consequences and what investors can take away from it.
Yeah, I mean, so as you say, land is an economy's most fundamental asset. So everyone needs a place to live, and every business needs a place to locate. So it's fundamental, it's unavoidable. You either have to buy it and own it, or you have to rent it. Now, because land is fundamentally scarce, and certainly land in good locations where people want to live and do business, it ultimately takes the surplus of all economic progress. And when I say surplus, I mean the windfall gains where as societies grow, as technology improves things and improves productivity. And because land takes all of that gain ultimately, it makes it an extremely valuable asset, and an asset that people like to speculate in and like to secure borrowing against, which drives things up over the top. So, when your rents go up too much, when you have to pay too much interest on your mortgage, you cut back on other expenditure, that sort of generates a recession. And when that happens, people stop spending, property prices come down, but really what it is land prices are coming down. And when that happens, when it's banks have lent too much against land, against property, then that brings down the banking system, which means that businesses don't get the credit they need to continue functioning. So then they lay off workers and you get a major recession. So that's basically why land is so fundamental to the cycle, and why some people call it a property cycle, but it's kind of, I think it's really an economic cycle. Now, there was an economist in the late 19th century by the name of Henry George, who wrote a book called Progress and Poverty. And in it, he set out two main aims. One was to ask the question, why do we keep getting these periods of boom and bust? He was an American, so writing about the American economy. And, you know, as I said, it's a cycle that's been going on for over 200 years. So since 1798 in the US, and he was writing in the 1870s. So for almost 100 years, why has it been going on? And then the other question was, despite all the amazing progress that the American economy was experiencing, so if you think back to the 19th century, you know, the settlement of the entire sort of continent of the United States, the amazing kind of innovations that came out of the railroads, and, you know, heavy industry and so on, is creating enormous prosperity. But at the same time, there was sharply the society was getting sharply divided between those who owned land and those who didn't. And he wanted to understand why that was happening. And he, you know, discovered the land cycle, essentially. And he then said, well, you know, the reason that land goes up in value ultimately is because there's a lot of public investment, and societies are growing and people are getting more prosperous, and therefore they're bidding up the price of land. And that value is created through public investment. And so actually that's what should be ultimately the basis of taxation. That public investment is drawn back into the public purse. And actually you shouldn't be taxing people's wages and business profits, because that's private value creation. And so the tax system should basically be turned around. Well, it just so happens that the most influential and powerful and wealthiest people in society own all the land, and they didn't really like this idea. And Henry George, unfortunately for him, was, well, fortunately for him, but unfortunately for the vested interests, was extremely popular, because clearly this explained what was going on in not only in America, but also in the UK. And you could start to see the emerging sort of system of boom and bust in Australia. And so he was running up against vested interests all over the place. And he was very influential on progressive politicians in the UK. So the Liberal Party adopted his idea in the early 20th century. And it was actually championed by people like Churchill, who at the time was a Liberal MP, and also David Lloyd George and Gladstone and others. And once it was a serious proposal on the table, it had to be stopped. And so in the UK, the House of Lords voted down the budget of 1909, which created a constitutional crisis, because you know, the House of Lords not supposed to stop money bills. In the US, they had a slightly more insidious way of stopping George. They effectively took land out of the economics discipline. So people talk about labor and capital, but they never talk about land in terms of economic kind of analysis. And the reason for that was there were a number of economists in the early 20th century who basically claimed that land was a form of capital and therefore didn't need to be treated in its own right. And therefore, it was never seriously proposed as a solution to boom and bust, which is essentially why no expert can really understand the cycle, because they can't diagnose it properly. They can, of course, understand that sometimes banks lend a bit too much money for property, and they can see property prices rising, but they don't fundamentally understand why this is central to the economic cycle, and why when it goes over the top, you get a major banking crisis. And they don't see it happening in 18-year phases. And so, unfortunately, as the Queen asked when she went to LSE in 2008 and said, well, why did no one see it coming? Yeah. They were able to give lots of answers about Chinese saving so much and pushing bond yields down, and lots of risk taking, but no one really understood who was managing that risk. And all these sorts of issues, while important, weren't fundamental to the answer. So this is why no one sees the cycle.
Yeah, symptoms rather than the root cause. You know, the Henry George story I find fascinating, because you know, it's you know, in the economics profession, I'm not university educated or anything, but just in terms of economic discourse that you see regarding that what drives boom and bust, you don't hear anything about Henry George. He's effectively been written out of history to a large part. I mean, it's only through yourself that I'm familiar with him, and yet at the time he was one of the best-selling non-fiction writers of his time, right?
Well, it's said in the last decade, or maybe last 2 decades of the 19th century, the only book that sold more copies was the Bible. And I mean, I mentioned he was very popular. He was very influential all over the place, and it wasn't just in the Anglosphere. I mean, he was very influential in China, Sun Yat-sen, and other people like that. He was influential in Russia. So Tolstoy was a big advocate. Einstein also in Germany. So he, I think even now, if you were to count all the sort of copies sold of all these various economic textbooks, talking about Samuelson's really famous textbook that came out in 1948, probably Henry George, even after a century of obscurity, is probably the most widely read. So it just goes to show how successful the I don't know what the word is, but counterattack was against his ideas, because it went up against such influential interests who didn't want to see his solution enacted. And it's very short-sighted, because the alternative in Russia, for example, was a much darker revolution, which was much more problematic. Whereas really the Georgist solution is ultimately freeing the free markets to do what it does best, which is to allocate resources efficiently and provide the right incentives to do so. Unfortunately, we live in a system of land monopoly.
Yeah, which goes into another story that you told me about, which I'd never heard of before, with the game of Monopoly originally being proposed and delivered as a example of how the current economic model that we have doesn't work, rather than as a fun family game, and then proposing an alternative to it, which involved land. Some of those interesting things where you referred to earlier about factors of production, where today, if you're reading The Economist or whatever, or well, not to bash The Economist too much. If the economy is presented as a combination of the factors of production being labor and capital, and capital has been privileged very heavily in recent years, and labor has not, and that's why we have populism. And it's very reductive how things are brought down to labor and capital, when in reality, land has a huge influence on this, but it's just something that's not spoken about so much. Because when you're talking about land, people have various ideas of it. Often they think agricultural land, or they think of these places where they're built. They're going to build huge new hamlets and villages out in the countryside and things like that. But actually, it's the effect of the land cycle can be felt pretty much everywhere, and it's especially it's especially concentrated in big metropolises like London, though you would never hear it referred to in that way. We do have some good questions in the chat here. I thought maybe we could take a couple of them here before we go into where we're headed in the cycle in general. Andrew says, "Hi, Boaz. Hi, Akhil. Good evening to you, Andrew. Thank you so much for joining us." And indeed to Saw VTI, who says, "Hi, all. Very good evening to you too." We do have a question on demographics from Jason. Is demographics not a big factor of the economic cycle as well, Akhil? Could you comment on that?
Yeah, well, wherever people are moving to, that's where land prices go up. So you have big demand for a scarce asset, and it's not just population growing in absolute sense. It's also people moving from one city to another, and where they're moving to, prices go up, and things can go over the top. And when things go over the top, it can start to bring the banking system down. So it's a factor, but it's it needs to be seen in that context.
Arthur Schopenhauer, I doubt, maybe not his real name, asked a question. So a presupposition of Akhil's theory is property rights, brackets, or is it? What happens when totalitarian and oppressive governments take over? Does the cycle continue? It's a great question. So, Akhil, in places where communism or even there aren't any property rights, where it's really much less developed, and the rule of law is mostly replaced by the rule of man, does the cycle still express itself? Can this really be found anywhere where there is economic activity, or is it something that is maybe more unique to sort of our Western liberal societies where property rights have been, instilled and are upheld by the law?
Yeah, I mean, there's quite a lot in this. So I'll just try and keep it relatively simple. I mean, property rights, the key bit about property rights in the West is security of tenure. So if you have the right to occupy it. No one comes and takes away. It's not absolute ownership to do with as you will. That is a kind of a element of fantasy that has come in to justify the current system that we have. And of course, we've exported it all over the place with some pretty horrendous consequences. Now, in communist regimes, I mean, if you can't speculate in real estate and create credit, bank credit against it, then you're not going to get the boom and bust cycle. But you are still nevertheless going to get a build-up of economic rent, which at some point will be exploited. If the land is all controlled by the government, it gives government enormous power over its citizens. So essentially, in any society, in any system, whoever controls the land effectively controls a society. And that actually, you mentioned the game of Monopoly. That is the ultimate message of Monopoly. So it was invented by a suffragette in the early 20th century. She created this thing called the landlord's game with two sets of rules. The first one, the set of rules that we are more or less familiar with through the game of Monopoly that we play. And then a second set of rules where you actually just tweak the system slightly. You had the same kind of ideas, but everyone would pay a ground rent into the public purse, which then became the fund through which you increasingly had free utilities and free education and so on, and no one could bankrupt anyone else. That's basically the system Monopoly, the game of Monopoly as it should have been. But she pointed out that whoever ends up controlling the land controls society, and that's true whether in a Western capitalist system or in a communist totalitarian system as well.
And more recently, we've been getting predictions that in in the 2030s, you'll own nothing and you'll be happy. I think that was from the Davos crowd, which got many people very incensed, and rightly so, back in 2020. Yeah, it does feel like when you were talking about how Henry George came up with this in an environment when wealth inequality ultimately was very much on the rise. Here we are again today, Akhil, and wealth inequality is very much a thing, and it now gets talked about more and more and more. So this kind of these kind of economic theories, maybe they get turned to a lot more. Do you think this is something that, while it has been misunderstood for so long, this is going to really catch the public interest and maybe change policy in the future?
Well, I mean, it's undeniable that inequality and housing inequality and wealth inequality is a really big political issue. I'm not seeing many solutions proposed that follow Henry George's ideas, and I'm not seeing many analyses on that way. So one example is the 2014 book by Thomas Piketty, the French economist, who amassed an amazing data set for over 100 years, pointing out how returns to capital have basically explained most of the increase in inequality. And it took an MIT student to actually then say, well, most of what you're seeing as returns to capital is actually returns to housing. And so, many critiques of capitalism exist, but they are almost co-opted into the same short-sighted way of viewing things because they treat land as a form of capital. And so they almost buttress the system that we have as it is now, not as the system that we should have. And ultimately, inequality can't keep going up and up. At some point, those who have the least have the most interest in throwing the system over. And when you get revolution, who knows where that goes? It often, rarely ends well, at least not in the short term. So that's a warning. Whether that's going to happen in the next decade or in 20 or 30 years, it's got to happen at some point without some more sensible reform.
Well, Akhil, you got my vote if you do decide to stand and change things for yourself. We have received some great questions in the chat, which we shall return to in a little bit. But I think it would be good to bring things very much into the present with where we are in the 18.6-year cycle. I believe we have a very nice slide that Akhil has prepared for us, which we could take a little look at. Yeah, Akhil, could you tell us what we're looking at for folks who are new to your theories, and then we can go into where we are and what it means.
Okay, and now I should point out that I'm not the originator of the 18.6-year idea. I mean, I mentioned Henry George. He analyzed the land cycle, but it was actually a Chicago economist by the name of Homer Hoyt in the early 30s during the Great Depression who amassed he gathered together all the data on Chicago land prices from about 1830 and discovered four great 18-year cycles in Chicago, which, once people started looking into it, they found was all over the US. And then an English economist, Fred Harrison, in the 70s resurrected Hoyt's thesis and applied it to the UK and to other countries. So I just want to make that clear. So what we have is, I mentioned it was an 18-year cycle, 14 years up, so and interrupted by mid-cycle slowdown. So you can see two 7-year highs effectively, with the blue line in the middle. That's the mid-cycle slowdown, and then a much bigger second half, which accelerates into a peak. The last kind of acceleration is roughly 2 years of proper madness and mania, and then a major crash at the end, lasting sort of 4 years. Not necessarily just crash for 4 years, but 4 years of difficulty and problems in the banking system and high unemployment and people not being able to get much done, completing the 18-year cycle. So that's essentially an illustration of the overall sort of structure of the cycle. The current cycle started around 2011, 2012. It's, there's no one day or 1 minute when the cycle starts. You just kind of have to look for the turn. It's usually some major blowout event or major scandal emerging or something. So I'd say, the Eurozone crisis in 2011, the Draghi statement in 2012, whatever it takes, the LIBOR scandal that emerged in that year probably was the final act of the previous cycle. Then we had 7 years up into 2019. The cycle ran on a little bit to 2020. Notice how at the start of the pandemic, everyone was saying, well, this is the worst crisis since the Great Depression, or in the UK, the biggest recession in 300 years. Of course, it wasn't, because we weren't having a falling land market. Banks hadn't over-created credits during the first half of the cycle, so we didn't have a banking crisis. And actually, the recovery has been rather swift. We're now one or 2 years into the second half of the cycle, and we should have a peak 7 years after the midpoint, so around 2026, and completing a 14-year expansion, and that's when the crash will happen. And it generally is the case that the bigger the boom, the bigger the bust. Alongside where we are now, what you tend to see is banks really creating money, and as if there's no tomorrow. So an era of very easy credit. We haven't really seen that yet, but it's starting. You tend to get an infrastructure boom because there's a lot of public investment. It's a typical response to the mid-cycle recession by governments. We're having it now. We got it in after 2001. That pushes commodity prices up. Wherever infrastructure goes in, that pushes land prices up. This businesses and households are drawn to those places, pushing up prices even further. Banks are only too happy to lend to new areas, which is not the case in the first half of the cycle. 2 years before the peak, it goes into overdrive, and this is when you start to see really outlandish behavior. And the world is very much enamored of property speculation and making money and spending money. People get very excited. They start building the world's tallest building. You get pronouncements how we've reached a permanently high plateau of property prices, and people extrapolate those final 2 years into the indefinite future. And as a consequence, you start to get rising inflation. Interest rates have to start to go up at that point. I mean, they can go up before that, but it's really at the end of that when rising interest rates really start to have an effect. And then at some point, a bank will have gone over the top, will start to fall over, and that will then kick off a chain reaction, which then brings the entire banking system down.
Right. Well, plenty to look forward to then, Akhil. Thank you very much for this slide, by the way. I think this is a great little illustration. I think we can go back to our normal setup here. Yeah, there we go. And okay. So 2 years. We have to wait 2 years, Akhil, before we get the outlandish behavior. I mean, how outlandish is this going to be? I think we've seen a fair bit of outlandish behavior already, have we not, over the past 2 years?
Yeah, bet we'll see more. I mean, I don't think you should overestimate or underestimate, human capacity for really serious stupidity and mismanagement of money and so on. I recall, for me, this was probably the worst thing. I'm sure there's many worse examples, but into the peak in the last cycle around 2007, 2008, depending on which country. And the US tends to lead the cycle, so it's a bit earlier. I mean, most of the construction boom in the world, not most of it, but the biggest sort of example of it was in Dubai. And so they built, you know, the world's tallest building, the Burj. Actually, I just read the other day, it was called the Burj Dubai until the crash. They needed to get a bit of bailout money from the Qataris, I think. And so it got called the Burj Khalifa in honor of that. And I thought, but they were building these sort of small islands in the bay or the Gulf, or whatever you call it. You know, totally man-made islands. And I understand that each one, I think there were 20 or so, were going to have their own microclimate. So one was going to resemble Sweden or something. So Nordic climate. I mean, what a total egregious waste of money that is. And they never got built. I do apologize if you've got any Dubai property developers listening in. But, you know, a spade is a spade after all.
Why would anyone go to Dubai if not to visit Sweden, you know?
Well, exactly. So none of those islands got built out, I don't believe. And, you know, a few years later, they're all sinking back into the sea because, you know, that's what you need to keep maintaining such things. Anyway, so you get, you know, really silly things, and you'll get something crazy. I mean, in the late 80s, the peak in 1990, the real kind of crazy stuff was in Japan. And, you know, everyone's heard how the land and under the Imperial Palace in Tokyo was worth more than California, and there was a roaring trade in golf memberships in Japan.
Right.
I'm putting all of these little anecdotes in my book. Yeah. So the value of the trade of golf memberships in landlocked Japan, there's not much spare land in Japan. There's not really too much space for all these golf courses, but nevertheless, this is what speculation does.
Yeah.
And so the value of golf memberships, which could be traded on an exchange, I think it was called the Nikkei or the something Topics golf exchange, golf memberships exchange, it was 20 billion. And, you know, that number was bigger than all but 15 of the world's economies. So it was truly ludicrous behavior. So we'll have something of an equivalent basis in the next few years.
Must have been pretty crazy to play golf on those courses, huh? I mean, talk about privilege. Imagine the kind of people you'd bump into when you were wandering around there. They'd be absolutely minted.
They would be minted. Yeah, well, Japan made a lot of money.
I would wager that some of the people you would have met on those golf courses in Japan were behind some of the property development in Dubai, including those islands. I imagine there's got to be somebody who turns up in both of those places, and maybe they'll turn up again in whatever we see in the next 2 years' time. I mean, which leads us into what that may look like when it comes to digital real estate, which I think we can go into in a little bit as well. One last thing on the topic of outlandish behavior. I thought we could tie it in quite easily, actually, with the topic of land being created offshore out of by dredging up sand and creating these small islands in Dubai. It does pose a sort of geopolitical question. I think it ties in quite well with what the cycle kind of does. Because what the cycle does for geopolitical relations as well. So I'm thinking of China and South China Sea. They are very much in the island building game. They are very happy to make sure that these islands that they have built stay afloat. You know, they dredge up more sand. They've got these very nice runways on them that you can't visit them if you're a tourist, but they like these islands because they can put all these military installations on there. And I thought it would tie in quite well with what you think the geopolitical scene is going to look like in the next 2 years, because geopolitics has become increasingly important, or it's returned to importance for investors once again.
Yeah, so I mean, this is linked a bit more to another cycle that I look at called the long cycle, the Kondratiev wave. But just to relate it back to the real estate cycle, So when things are going way over the top towards the end of the cycle, it's in, you know, all governments' interest to keep the party going, keep us distracted from any kind of particular dissenting voices or things that might get us to actually look at the kind of craziness that's going on for what it is. And one of the things that you can do to create that distraction is to sort of effectively create an enemy or stoke tensions and so on. So that tends to be, I mean, it could be something relatively benign, like, putting on the, games or some other entertainment. But it could be, I say that because it could be geopolitical and something to do with, kind of conflict. Now, related to a longer term cycle, which is also peaking in the 2020s, the long cycle, is you see this in a commodity in a wave of commodity prices, roughly 25 years up, 25 years down. Doesn't mean it's straight up and straight down, but the long term trend tends to be up and then down in those waves. And essentially what happens is, as the cycle matures, you get increasing conflict and tension between the great powers of the day. So we have the US and China at the moment, but into the previous peak in the late 70s, it was between the USA and USSR. Into previous peaks in 1920, it was, of course, the British and German empires, and so on, in previous cycles before that. And ultimately, what these conflicts are about is to do with control of trade and access to new markets, and who gets to control the way in which that trade takes place. And you're seeing all of that again with the US and China. It's, of course, you can, whether you frame it as a sort of rising power, and established power coming into conflict in the Thucydides trap or whatever. What it is ultimately a conflict over access to markets and over access to resources. And unfortunately, the point of greatest geopolitical jeopardy is in the aftermath of a real estate cycle, because when things are turning down, governments of course need a distraction to demonstrate it wasn't them that had caused it, and of course to a certain extent it was, and so creating an other, the enemy, or stoking tensions is one way of doing that. Now, when you have two evenly matched powers with web of alliances and many potential flashpoints, unfortunately you can't manage that situation. It can get out of hand very quickly. So that's unfortunately the dark side of all the things that I'm talking about.
I know this is a very hard question, but any idea on timing?
Well, I mean, it won't, the major sort of conflicts and so on will be kind of after 2026, potentially, maybe the early 30s. I mean, these things don't just happen, and they're not switched on and off. No. They take time to build. There'll be efforts to prevent it, hopefully, and maybe some will work for a time. So late 2020s, early 2030s is probably
right. And
the time of greatest jeopardy. Yeah.
Right. So it's after the big crash, ultimately.
Well, that would be how I read it, because before that, people will be very happy with how things are going, and so governments will want all that to continue, and there'll be much self-congratulation at how well they're managing the economy in the coming years.
I think it would be a good time to have a few questions. From this one, we go to...
I see there's a suggestion that I should get out more. I'll take that on board.
Well, all the lockdown rules in England have been relaxed, so we'll all be able to get out more, hopefully, in the coming months. I think I'd like to start with one that actually was sent through very early on in this episode of Southbank Live. This is from Vincent. Good evening, gents. Good evening, Vincent. Akhil, have we seen the market bottom yet? And when will it be time to start buying precious metals? So yes, in terms of the market bottom, I'm assuming Vincent is referring to the stock market. But Akhil, enlighten us. Have we seen, now that we've seen the mid-cycle slowdown during the COVID years, which will have hopefully ended by now, have we seen the market bottom?